In this video, we're going to look at the technology company Canon. And what I do in my videos is I run my discounted cash flow model to figure out the true value of a stock. And then we look at the financial ratios and compare them to similar companies. And I'm going to take you through the whole process, so it's like you're doing it with me. The ticker I'm looking at is the Canon on the Tokyo Stock Exchange, not the Canon on the American Stock Exchange. The reason is Canon reports all their financials in Japanese yen, and I don't want to have to convert that to US dollar. So it's so much easier if I just look at the company on the Tokyo Exchange because it has the market cap and stock price in yen and not in US dollars. It doesn't make a difference if I use the Tokyo Exchange or the American Exchange. It's all the same information. To show you why it doesn't make a difference, if I look on the US Exchange, the stock price is CAJ and the price is 1935. And if I convert that to Japanese yen using the exchange rate, that's 2,076 yen, which is roughly what it's trading at on the Tokyo Exchange. Same thing with the market cap. It's $20.5 billion on the US Exchange. And if I convert that to Japanese yen, it's 2.2 trillion yen, which is what it's trading at on the Tokyo Exchange. It doesn't matter if you buy the stock on the Tokyo Exchange or the American Exchange, you're paying the same amount of money. The stock is always trading at the same price on all the exchanges. If it wasn't, that would create an arbitrage opportunity. So let's get started with the model. The company has a market cap of 2.135 trillion yen. And they're trading at 2,041.5 yen. And next we need their free cash flows. This is the cash that's remaining after running a business and paying expenses. This is important to have free cash flow remaining because you need to provide some value to your investors, either in the form of dividends or in the form of a growth stock. So let's go to the cash flow section and pull the free cash flow. And you can see it's all over the place because companies, if they invest a lot one year in their infrastructure and their business, free cash flow may go down that year, but if they're not investing as much in other years, it's going to be a lot higher. Let's go to the income statement and get the net income. And this is the profit and loss. Now let's get the revenue. This is the total sales, and that's also on the income statement. And the numbers are pretty good. They're all positive and fairly consistent. So let's get the capital structure of the company so we can figure out what discount rate to apply to the future cash flows. I had to pull the interest expense from a different source, but they pay 8.4 billion yen of interest on their debt. Let's figure out how much debt they have. We'll go to the balance sheet, then go to the liability section. Current debt is 42 billion yen, and long-term debt is 357 billion yen. So they pay 2.1% interest on their debt. Since interest is tax deductible, let's get their effective tax rate. So the income before tax is 195 billion yen. And the income tax is 56 billion. So the cost of debt is 1.5%. Let's get their current assets because we need to look at their ratios later. We'll go back to the balance sheet. And current assets are mainly cash, accounts receivables, and inventory. And that's 1.8 trillion. And current liabilities are debts and payables which are due within 1 year, and that's 960 billion. And stockholders' equity is total assets minus total liabilities. That's 2.7 trillion. And EBIT, earnings before interest and taxes, or operating income, and that's 175 billion yen. So their cost of debt is 1.5%, and they have 13% of debt in their capital structure. The cost of equity is 8%, and they have 87% of equity in their capital structure. So the weighted average cost of capital is a combination of the cost of debt and cost of equity. That's 7.16%, and that's what we're going to discount the future cash flows by. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today, and we get a value of the company of 1.65 trillion yen. We divide that by 1 billion shares, and we get an intrinsic stock price of 1,578. That's the value of the stock according to my model. That's what I say the stock is actually worth today, even though it's trading at 2041. So it's trading at a 29% premium. So it's a sell according to the model. Let's see what Simply Wall Street says. They're a little higher. They're at 1,700 yen. So they're saying it's also overvalued just by 24% instead of 29%. Let's look at the historical stock price to see where the stock has been trading. So it looks like it was way up there, close to 4,000 yen, but it's come down in the past 2.5 years. It seems like it's on a steady decline. The stock price is really predicated on supply and demand of the market. So the market just feels the stock isn't worth 4,000 yen anymore, and they keep pushing the price lower and lower. Let's look at their financial ratios. So they have a PE ratio of 17.1. That's not too bad. I like to see under 15. They have a price to sales ratio of 0.6. That's really good. That's price of stock over sales per share. A really good price to book of 0.8. That's price of stock over book value per share. They have a good current ratio of 1.9, so they can easily cover their current liabilities. They have ROE of 5%, so they're not providing much of a value to the equity holders. That's net income over equity. They could cover their interest 21 times, so no problem there. The best way to look at ratios is to compare them to similar companies. So I also did a video on HP, and that's right here, and Canon's right here. And the PE ratio, HP has a better PE ratio. HP has a better price to sales ratio. Canon is better in price to book, current ratio, ROE, and debt. HP is 100% debt, so they have negative ROE and negative price to book. HP is also a bigger company. If you convert the 21 billion market cap to Japanese yen, they're at 2.3 trillion yen, and Canon's 2.1 trillion yen. So let me know what you think in the video. I hope you learned something new. Thanks for watching.